What's up guys, what's up friends, welcome to my video. Hey, what's up guys, what's up friends, welcome to my video. My name is George Chitimbo, a student of Bachelor of Entrepreneurship, and I'm here to help you pass through financial management, discuss for you financial management. Specifically today we are going to look at topic 1, which is the introduction part of financial management. Therefore, colleagues and friends, I've seen it very crucial for me to do this video because as very many people were approaching to me, I couldn't get time to fix time for everyone. Therefore, I've decided to make a video. Hope it is helpful to you all as you are heading towards your courseworks. I hope the video will be beneficial to everyone. However much, I'll try to make you understand the concepts, and I'm open to critics. I'm open to adjustments. Any suggestion, I'm open to them. Therefore, immediately without wasting time, let me get into the video. So we are going to look at financial management, and the first topic is called the introduction part of financial management. But first and foremost, when we talk about the introduction part of financial management, just know that we are going to look at things like the definitions. So when we talk about the definition, we talk about the definition of financial management. We are going to look at the roles of financial management. We're going to look at the roles, who is a financial manager, and the roles of a financial manager. We are going to be able to look at the objectives of a firm. We are going to look at objectives of a firm. We are going to look at the major finance decision or the scope of financial management. I will also look at the concept of risk and return. From there, we shall proceed to know the mathematics of money. And under mathematics of money, we shall look at the concepts like time value of money, future value of money, and the present value of money, and annuities. So that is the context of the introduction part of financial management. It considers definitions, objectives, roles, financial manager, objectives of a firm, and the mathematics of money, where we look at time value, future value, and the present value. So my friends, when we say financial management, we are going to look at that definition first. So financial comes from the word finance, and then management, we simply know it is the planning and controlling. But then financial comes from the word finance. So, and finance, we know it deals with money, or we call them funds. It deals with funds. And funds are resources. These are funds, these are resources. Therefore, colleagues, financial management, it is that managerial activity concerned with raising and allocation of the firm's financial resources in order to attain the firm's objectives. It is that managerial activity you do to raise and allocate the firm's financial resources to attain the firm's objectives. For example, if I say I'm buying a motor vehicle at 50 million using the firm's money, it simply means that I'm allocating 50 million into an asset, which is a financial resource, in order to achieve my objective, which may be maximize profit, and this vehicle is going to generate for me profits in return. So that is the definition of a financial management. As you can observe from the slides, you can also relate to what you've been taught in class by your lecturers. But this one's to give you a brief insight for those of you who didn't understand from the beginning and to clarify for you certain points. So let us go to what we call the roles of a financial manager. Roles of a financial manager. And first of all, who is a financial manager? As you are seeing from my slides, certain points were repeated, so are not necessary, but let's go to the roles of financial manager. So you can't go into roles of financial manager without knowing who financial manager is. So a financial manager is a person who is responsible in a significant way to carry out the finance functions. Everything related with finance, it is done by the financial manager. Dear friends and dear colleagues, just know that some of the definitions does not matter whether how it is displayed in the slides, but I try to add more and simple thing from my knowledge, from my brain, and throw it here. So if you listen carefully, you will understand. And now there are 4 major roles of a financial manager. Other books, they can give you like 11, 10, but majorly there are 4 roles of a financial manager. And if you find a crucial examiner, they only look for these 4, because mostly it is allocated with 80 marks. And the moment you give these 4, you have received your 80 marks. However, I will not limit you to add others, but this is how you go through it. So the first role of a finance manager is raising of funds. Raising of funds. And what do we mean by raising of funds? A financial manager is responsible to raise the firm's or the company's funds. In that is responsible to identify the sources of finance or the sources of funds. You see, when we say sources of funds, they can be either long-term or short-term sources of finance. It can be either debt or equity. So long-term sources of finance and short-term sources of finance. It can be debt or equity. And what do we mean by debt or equity? You see, if you say that you want to start a business, or maybe you want to sell sweets, and the business requires you like 50,000 Ugandan shillings, and in your pocket you have like 20,000 Ugandan shillings, and you go on an extra mile, you borrow 30,000 Ugandan shillings from a friend. That one simply means that the 20,000, the one you had from your personal pockets, that is what we call equity. And the money you've borrowed, that is what we call debt capital. So the finance manager is responsible to identify the sources of funds, either the debt or equity. And where does the debt financing come from? From financial institutions. So you as a financial manager, you must identify the financial institutions with lower interest rate if you are to go for the debt financing. So that's what we call raising of funds. Simply looks at the sources of finance. Then allocation of funds. The financial manager is responsible to allocate the firm's funds. And funds are allocated into assets. Therefore, the financial manager should allocate the firm's resources into either long-term assets or short-term assets. Therefore, allocation of funds deals with investment of firm's funds either into long-term assets or short-term assets. And short-term assets examples include stock inventory, cash, treasury bills, debtors, and long-term sources of long-term assets. Long-term assets on the other hand include furniture and fittings, motor vehicle, land, among others. You get. So you must decide where to commit the fund's resources, and also the expenditures that the business or the firm is likely to occur. You must allocate that money in a significant way to avoid losses to the business. Another one is called profit planning. You must plan for the profit. You must plan that the organization must yield profit, should not go into losses. So when you are planning for profit, you have to consider areas like pricing, costs of operation, and what is the company's capacity of production. If it is a manufacturing farm, you get. So you have to put profit into consideration. Therefore, this role is done by a financing manager to plan for the profit of an organization. Then understanding capital markets. Yeah, these capital markets are sources of finance. So capital markets include like financial institutions with the borrowers, the creditors. So as a finance manager, you should understand how these capital markets work in order for you to get the most efficient one, or to get efficiency and to avoid losses. For example, assuming there are two banks, Stanbic Bank and Centenary Bank, each offering a loan or a business loan. You as the financial manager, you have to look and see which one has a lower interest rate. I may choose to go with Stanbic because maybe the interest rate is lower than that of Stanbic or Centenary Bank. You get. So as a financial manager, if you make a decision and go with maybe a lender who has a higher interest rate, and leave others, it means that you don't understand capital markets, and therefore we are going to make the firm lose its money in an inefficient way. So you have to be able to know how these capital markets, how they work, since they are the major sources of funds for the firm. So with that, those are the major roles of a financing manager. However, some books can add some points, but as you are bringing those points, you have to say other roles of financial manager include risk assessment, as to assess the risk of the firm. To assess the risk before making an investment, you have to see whether the risk is high, moderate, or low before making an investment, either in long-term assets or short-term assets. Another one, budgetary controls. You have to plan, budget, and control those budgets and live in line with the budgeting. So those can be some of the other roles of a financing manager. So I advise you, as you are listening to this video, this audio, be able to relate with my slides and note down things which have not been added here. I would be adding them if I had a laptop or a gadget that can highlight, but simply I'm using my phone to explain you the things. So there is no way how I can add. I don't have that feature on the phone. So, but we move slowly by slowly. We shall get there soon. So let's go to the scope of financial management. Scope of financial management, sometimes it's called the finance decisions. So there are majorly 4 decisions of financial management. And these include the investment decision, stock capital budgeting decision. We have the working capital management decision, stock liquidity decision. We have the financing decision itself, not finance decision, but financing decision, and a dividend decision, as you can see. So the investment decision, stock capital budgeting decision, this one simply deals with allocation of the farmer's resources or funds into long-term assets. So you commit farm's resources into long-term assets. For example, land, motor vehicle, furniture and fittings. Therefore, since you are making an investment into long-term assets, as a finance manager, you have to be very crucial when you are making this decision, because in most cases it is not reversible. For example, you assume buying a motor vehicle of 100 millions, and after like 1 month you say you made a wrong decision. It means you are going to chase the farm out of business. You cannot just reverse. And a motor vehicle, they have a higher depreciation rate, these assets. So you have to be very crucial. You have to plan, investigate, understand which one do we need and which one we don't. we don't need. So the investment decision for it deals with allocation of the farm's resources or funds into long-term assets, and you cite some examples like land, motor vehicle, machinery, etc. Then let us go to working capital management decision. Sometimes it's called the liquidity decision. This one deals with allocation of the farm's resources into short-term assets or current assets like cash, debtors, commercial papers, treasury bills, inventory. All those ones are examples of current assets, and therefore you can acquire them through working capital management decision. So that's that's the difference between the investment decision and working capital management decision. You see, the other one deals with long-term assets or current assets or non-current assets, and this one deals with current assets or short-term assets. So let us go to the financing decision. So the financing decision, for it looks at the capital structure of a firm and the sources of funds. Acquisition, how are you going to acquire the funds? So the financing decision looks at the sources of finance, whether long-term sources or short-term sources of what? Of funds. And it also looks at the capital structure. Capital structure is the combination of a debt and equity capital, or is the mix of debt and equity capital. I said debt is the money you've borrowed, and equity, the money from your personal resource, from your personal pockets. The money that is contributed by shareholders or investors of the company. But debt capital is that capital you've borrowed. Therefore, as a financing manager, you have to determine the capital structure when you are dealing with the financing decision. The capital structure, you may decide to say maybe we are using 20% debt and maybe 80% equity, or 80% debt and 20% equity. But that one will automatically show that you are not performing well. But that is the financing decision, deals with capital structure and how you are going to acquire funds, whether long-term or short-term sources of finance. Now let us look at the dividend decision. Dividend simply means a profit or a return to the shareholders. And shareholders, these are the people who have invested money in the initial stages to start a company. Okay, so they have to get a return on their money. So it's called dividend. So the dividend decision looks at how, on the return to the shareholders, it spells out the dividend policy. It looks at the dividend policy to be taken. So let me give you a scenario. Once profits are got or are obtained by the company, so if the company has to decide the dividend policy, are we going to distribute all the profits to the shareholders? Are we going to invest all the profits into the company? Or are we going to distribute some to the company or some to the shareholders? You get? So that's how they determine. So the dividend policy spells out how the profits are going to be distributed to shareholders and the company. So some of the dividend policies, the common will have the residue dividend policy, where in most cases some money is reinvested in a business and other money is given to shareholders. We also have what we call the constant payout ratio dividend policy, where the shareholders receive a fixed dividend annually, or depending on the farmer's policy. But it is fixed. We say that every year we shall give them this amount of money as a dividend, whether we make a loss or we make a profit. So if we make an excess profit, it will be kept. That excess profit will be kept to cater for payment of shareholders' dividend in times when the company makes losses. So I'm done with the scope of financial management. Those are the 4 finance decisions. And now let's look at the objectives of a firm. objectives of a firm. So they are measured two objectives of a firm, and that is profit maximization and wealth maximization. However, there are other objectives, but those are the major two objectives of a firm. So objectives of firm, we simply have maximization of profit or profit maximization. As we hear the word, we know that profit, it means that we are getting money. It's the money we get after an investment. And how do we do this? So this objective of profit maximization requires a firm to maximize its revenue as it minimizes its costs of operation. Simply as you're selling your goods, you have to make sure that you make much more revenue, as well as you try to reduce the costs of operation. Okay, that's what we call profit maximization. It has disadvantages and advantages. Sometimes the disadvantages are called criticisms, and then the advantages are called justification of profit maximization. So from my slides, they started with the criticism stroke disadvantages, but let me start with the justification of profit maximization, or what we call advantages. The first one is going to be, it is the main source of finance for the firm. These ones are not in your notes, are not in even are not in my slides, so be noting them down. It is the main source of finance for a firm. Yeah, once the business makes a profit, it is able to invest money so that it can finance its operations than going into debts. You see, it's the main source of finance for the firm. Another one, it addresses the primary concern of the shareholders. Remember, the shareholders are interested in profit, in maximizing returns, so it addresses their primary concern. Another one, it shows efficiency of an organization, shows operating efficiency of an organization. One organization is making profit, shows that it is doing well than an organization which is making losses. Another one, it reduces risk of the business. It reduces risk of the business in that you can avoid going into business days if you've made a good profit that can finance your operations. So we have also other points from the slides here. Ensures economic survival. It also maximizes the socio-economic welfare. Firm's aim of maximizing utility can be measured in terms of profit. Management forces allocate capital, as you can read them from the slides. However, it has certain disadvantages or criticism. One, profit maximization ignores the concept of time value of money. So, as you're planning to maximize profits, it can take you 5 years to make profits. But remember, that is a very big period of time. Therefore, it is ignoring time value of money. You should achieve profit at least within a short term as you are heading towards a long run. So for it ignores the concept of time value of money. Another one, the objective may be in conflict with interests of other stakeholders like employees, suppliers, consumers. For example, for you, the major aim may be to maximize profits, and you end up offering not offering poor quality products to the customers. So it is in conflict, because for you want to maximize profits, you use low costs, you therefore by acquiring poor raw materials and end up supplying poor quality products to the customers. Hence a conflict. So the objective may be in conflict with interests of other stakeholders. Another one is the definition of profit is vague. When they say the definition of profit is vague, they simply mean that economists and accountants define profit into a different way. Therefore, as a financial manager, you'll be confused on which one to take, because you will see that accountants will only consider accounting profits. Maybe the economists will consider the macro part of the business, maybe the cash flows you get. So you become confused on which one to take. Those are some of criticism or disadvantages of profit maximization. Now let us look at another objective of a firm or a business, which is wealth maximization. Wealth simply refers, when you hear the word wealth simply refers to the present value of all future net cash flows expected from all assets in which financial resources of a firm have been committed. So if you commit 50 million to buy a motor vehicle, all the expected finance or money from all the expected money for all cash flow from that motor vehicle is what we call wealth. All the expected money the vehicle is going to generate is what we call wealth. So wealth refers to the present value of all future net cash flows expected from all assets in which financial resources of a firm have been committed. Therefore, wealth maximization, you can call it in bracket NPV. I don't necessarily mean that wealth is NPV, but because we are trying to determine the net present value, so you can say wealth maximization bracket NPV is equal to future value, which is FV, over 1 plus R power n, where n is the number of years. You can use that one for wealth maximization, because the formula which is here in the slides, it is a bit confusing. I would have written for you that one, but listen carefully and execute in a responsible way, because I don't have a light pen, a working gadget to edit from here. I'm just simply using my phone to explain this. So other objectives of a firm can include maximization of market share, maximization of earning per share, maximization of employee welfare, social responsibility, efficiency, risk reduction, among others. But those are the two major ones. So if they ask you to what extent does a firm meet its objective of profit maximization, so you give profit maximization vis-a-vis others. Or if they ask you objectives of a firm, I expect you to give in the first place you mention these two, then you give others. So I'm done with the objectives of a firm. I want to look at these concepts: time value of money, which is mathematics of money. But before I proceed to that, there is something which is missing in my slides, and I would like to talk about it, which is the concept of risk and return. I think you have them in your notes and from the slides you have with you, or maybe pamphlets, but my slides here, they are not displayed. But let me talk about the concept of risk and return briefly before I proceed to that. So listen very carefully, since I have not displayed it here. So the concept of risk and return, as you hear risk and return, so for every business you make, there is a risk. You've taken a risk. Whenever you're starting a business, you're making a risk, because you are committing your money into that business, which you don't know whether it will make profits or losses. And that uncertainty because you are not aware of whether you're going to make profits or losses, it makes it a risk. You get. And what do I mean by return? Return is what I will get when I start a business. What do I get in return for investing my money? Therefore, for you, if you start a business, for example, a sweet business, which requires you a capital of just 15,000, it means that even you will see that on the sweets you generate like maybe a profit of 1,000, and the return is very low. But assuming you've started out a restaurant which requires you maybe like 500 Ugandan shillings, 500,000 Ugandan shillings, so it means that you generate at least quite some good money in return, because you've used a lot of capital. You are in under business. You yield some good money or some good profit. Therefore, the concept of risk and return is grounded on an assumption that an investment associated with low levels of risk is likely to generate low levels of returns, while investments associated with high risks also are likely to generate a high return. So that is basically the concept of risk and return. Therefore, dear friends, if they tell you to explain the concept of risk and return, that's how you can explain. But however, you have to draw that graph. So that graph is drawn. You can check out from other resources, because I don't have here, but let me try to explain. So that graph contains treasury bonds and stock. And at treasury, it means that it is a low risk. And at bond, it means it is a medium risk, and then at stock it is a high risk. So as you can see that graph, at treasury you see that maybe you have 8% expected return, and then at bonds maybe you have 12% because the risk has increased, and the return will also increase. And then at stock, maybe you have your stock, it is a high risk, maybe you have a 20% expected return. Since the risk is high, the return will also be high. So that's what we call the concept of risk and return. Now let us look into mathematics of money. I call it mathematics of money. It's where we look at the things of the time value of money. We look at time value of money, future value of money, and present value of money, and annuities. So it involves calculations somewhere, somehow, but I'll try to explain to you briefly. You relate with what you've been told into the class. Now let us look into the concept of time value of money. I'm going to explain these ones in a simple way, in a layman's language. And these definitions I'm going to be giving you from my head are very paramount and are marked. They mark the concept that you understand. So, time value of money concept. As you hear the money, the word value, you have to value for money, but you have to value the money within a specific time. You get? So, time value of money, it is an individual or farmer's preference for a sum of money now, than the same amount of money at a later date. You see, your preference for a certain amount of money now than the same amount of money at a certain date, that's what we call time value of money. And why? Why would you prefer money now than at a later date? And there comes the reasons for time value of money. So among the reasons for time value of money, there are generally three reasons. The first one is called the investment opportunities. So with investment opportunities, since if you give me money now, I can use that same amount of money to make more money through investing it into a business. Then another one is the risk. The risk. When I say the risk, I'm meaning that the future is associated with associated with uncertainty. Therefore, I don't know what's going to happen in the future. Therefore, I would prefer money now than money in the future, time to come. For example, if I promise to give you 5 million, you prefer the money now simply because you don't know what's going to happen to me tomorrow. What if I die? What if I fall sick? What if I get an emergency and I use the money and I fail to give you the money? You get? So the risk or uncertainty in the future makes you prefer money now than in the future. Then another one, preference for consumption. You prefer money because you want to consume, you want to transact. Maybe you want to buy your girlfriend an iPhone, a phone, or something like that. Therefore, you will prefer money now than at a later date. You see? There are some people, there is a Uganda saying where they say, mbala zindi mungalo, you get? Yeah, that is it. So those are the reasons for time value of money. You can now look at the importances. You can refer to the book of Ignatius Ola for some importances of time value of money, but there are some here, you can pass through them. But the major ones are the reasons for time value of money and the concept itself. So for it does not have any calculation. And let me straightforward go to the future, present value and future value of money. Present value and future value of money. So let me start with the future value of money. So future value of money, guys, there are some formulas in my slides, but don't be confused. They all mean the same. It depends on who has written the book, who is the author, and how they have presented, but the concept remains the same, and I'm going to try to break for you everything within a short period of time. You know, the video is just only like 40 minutes, so I try to summarize everything briefly. So when it comes to future value of money, future value of money is the amount, in a layman's language, but it is marked. Don't get scared that you have to read what is there in the slides. You can take these ones. So the future value is the amount by which a sum of money now will grow in the future. Is the amount by which a sum of money now will grow in the future. Assuming you have 1 million, and how will this 1 million grow in the future? So the 1 million may grow by 4 million, making it 5 million. So the 4 million is the money, the amount which has grown from its present worth. You get? So is the amount by which sum of money now will grow in the future. And we know that money grows through a process of compounding. Through a process of compounding. And compounding simply means earning interest on interest. Guys, listen carefully. You can make summaries from here because some of the things are not here. Listen to the explanation and make some notes. So, or some summaries. I said future value is the amount by which sum of money now will grow in the future. And I'm saying that money grows through a process of compounding. And compounding means earning interest on interest in this case. For example, if I deposit 1 million onto a fixed bank deposit over in the bank on my savings account, and they are going to be giving me 10% every year or annually for my savings, on my savings. So this one simply means that in the first year they will calculate 10% of the 1 million and they will give me 100,000. So I will have 1 million plus 100,000, making it 1,100,000. But in the second year, they will calculate 10% of 1,100,000, not my initial deposit. You get? So I'll be getting like 110,000. So I had it to 1,100,000, making it maybe 1,210,000. You see, it goes on accumulating. And on year 3, they will calculate the 10% depending on 1,210,000. You get? That's what we mean by compounding. And therefore, the future value has got a formula to use. which is future value is equal to present value into 1 plus R power n. Some books note R as I to mean interest rate, but R is the same as also as interest rate, so don't get confused. That PV note or PVO you are seeing, it means present value today, but some books write just PV. And then FV, future value, N, some books write FV, so don't get confused. When I say PV is equal, FV is equal to PV into 1 plus R power N. So that is the formula you can use when you're doing a number. I can say, maybe suppose you deposited 1 million onto a fixed bank deposit at an annual interest rate of 10% for 5 years. Calculate the future value. So we say future value is equal to PV into 1 plus R power N, where the present PV is the present value, which is going to be 1 million into 1 plus R, which is 10%, which is 0.1, close bracket, power N, number of years, which is 5. From the question I've generated from here, from my head, that's how you can compute that one. So let's proceed and we go to future value. How do you get a future value when interest is compounded more than once during a year? So when we say interest compounded more than once during a year, if you hear words like quarterly, semi-annually, weekly, and daily, it means that interest is compounded more than once in a year. So if they say quarterly, it means that interest is compounded 4 times in a year. If it is semi-annually, interest is compounded 2 times in a year. If it is weekly, it is compounded 52 weeks in a year. And if it is semi-annually, it is 2 times quarterly, 52 or 4 times, then weekly 52 weeks, and then they may say monthly, those are 12 months in a year. Therefore, this is the formula you go with. FV is equal to PV into 1 plus R over M power NM, where M is the number of times interest is compounded. So if you hear such words, the words I've mentioned previously, just know that you are not going to use the first formula, you have to use the second formula. And point to note, this question is as they are set, or when they set them, they don't specify for you that you are going to use or interest is compounded more than once. No. You have to look at the question, analyze, and see if it requires a formula for future value, just or when it requires a formula of where interest is compounded more than once. So it's about your analysis and question interpretation. So here I can give you an example. Let me see. Let me try to generate one from my head. Assuming, suppose, okay, let me say suppose an investment worth 5 million shillings is expected to earn a return of 12% semi-annually up to 5 years. What is the future value of this investment? Suppose an investment worth 5 million shillings is expected to earn a return of 12% semi-annually up to 5 years. What is the future value of this investment? Therefore, you have to know that as you hear the word semi-annually, it means that interest is compounded more than once a year. Therefore, I'm going to say future value is equal to PV into 1 plus R over M power NM. So I'm going to say my present value is 5 million into 1 plus 0.1 to 0.12, remember 12% when you convert it is 0.12 over the number of times interest is compounded. Those are 2 times. Semi-annual means 2 times. close bracket, NM, which is 5 times 2. Therefore, you can be able to calculate using your calculators to get the final answer. Are we there? I think we at par. So let's proceed. So that's how you can calculate the future value when interest is compounded more than once and when interest is compounded once. So there is other formula which you can use for future value. If you don't use future value is equal to PV into 1 plus R power N, you can use that. You can use future value is equal to present value times compound value factor NI. That's when you use that formula when you're going to use the tables. Table A is the one for compound value factor, and you read up the number of years and percentage. So it's not catered for here, but I think they have taught you that, but you can take one of the two methods unless they have specified for you. Now let us look at the future value of an annuity. So you can also find the future value of an annuity. Therefore, they are not also going to specify the question that it is an annuity, but you have to look at the question and see. An annuity refers to a uniform stroke, a fixed stroke, a constant cash flow. So assuming when you say you are depositing maybe 2 million in the bank every year, that means that is a constant cash flow. It is uniform. Every year it is a must. You have to deposit 2 million. Therefore, it becomes a uniform cash flow. Therefore, you have to go to the form. You have to use the formula of future value of an annuity, whereby future value of an annuity is equal to A into 1 plus R power N minus 1 over R. Sometimes call it I. But if you don't use that formula, if you are told to use the tables, you can say future value of an annuity is equal to annuity times future value times the compound value factor of an annuity NI. Future value of an annuity is equal to annuity times compound value factor of an annuity NI, and that is called table B. If you have the tables, you can use that formula, one of the two, when you are trying to find a future value of an annuity. Now let us look at the present value, present value concept. The concept of the present value concept. Present value, as you hear the word is present, the value you have now. Therefore, the value you have now from future, you expect from future returns, but the definition is going to be future value refers to the amount by which a future sum of money is discounted to its present worth. So when I say present value, simply I mean that, okay, for example, if I say I'm going to give you 5 millions in 5 years from now, and for you now you say, no, I want my money now, I don't want that money in 5 years. It means that I'm going to compute and convert that money to its present worth, because the 5 million caters for the 5 months, for the 5 years, and for you want the money now. So I have to convert that 5 millions into this year. You will end up seeing like maybe I'm giving you maybe 1 million or 800,000, because that is its present worth. Therefore, present value is the amount by which a future sum of money is discounted to its present worth. Therefore, present value is equal to future value over 1 plus R power N. So, you can say assume an investment that promises to pay you the following cash flows, maybe maybe okay. I'll try to send some of the examples via my WhatsApp channel, Telegram channel, via my WhatsApp channel and Telegram channel and WhatsApp group, so you can be able to see, but you can relate with what you study in class. But that is the formula for future value. For present value, it is present value is equal to future value over 1 plus r power n. Now if you're not using that, it means that you are going to use present value is equal to, you're going to use that present value is equal to future value times present value factor ni. That's when that's using tables. You have to use present value is equal to future value times present value ni. So that's how you can that's the formula you can use to compute present value. But if they give you a present value of an annuity, how do you do it? Remember annuity, I said you can see when the it is a constant cash flow. So if you see that the cash flow is constant or uniform, and they are telling you to calculate the present value, then you don't have to use the first formula. You have to use this formula, which is present value factor of an annuity is equal to annuity times 1 minus 1 over 1 plus r power n in brackets over r, as you see from the slides. That's the formula you have to use. Or if you don't use that one, then you have to use present value factor of an annuity is equal to annuity times present value factor of an annuity ni, and that is table D. We call it table D. That's when you're using tables. If you get time, if we get a chance, I'll share these tables. You see how these tables look like and how you can compute. So we also have what we call types of annuities. We have perpetual annuities, deferred annuities, annuity due, ordinary annuity. You can go and read about them and how you can execute them. So we have the practical application of the present year of these concepts, and it's called the loan amortization schedule. I would like to do a loan amortization schedule with you guys if we get chance, physically, or if I get somewhere to record a video. When I have a whiteboard, I'll record and post it here. Thank you for listening to me. Thank you for listening to me. I remain George Timbo, a third-year student doing Bachelor of Entrepreneurship. Thank you for giving me time and watching my video. These videos will be shared to you in WhatsApp groups, WhatsApp platform, WhatsApp groups, WhatsApp channels, Telegram channels, and for future reference, they will be on YouTube, on my YouTube channel, which is Kim Wills. It's called Kim Wills, and I'll be dropping links towards finals. I'll be trying to make at least a video on each and every topic that I see is very paramount. I'm open to criticisms and